Hello, and welcome to It's Your Smarter Money with Dr. Laura and Professor Steve. I bet many of you would like us to tell you what we think is going to happen over the next year, 2 years, 5 years. But the truth is that any prediction about an uncertain future is just an opinion. We really don't know what's going to happen. Many people learn this the hard way. And so, how do you invest? Well, it always boils down to having a strategy, having a philosophy, and having the discipline to stick with the philosophy. And all along with that is the management of risk. And so, a good financial advisor has a philosophy, they have a strategy, and they help you have the discipline to stick with that strategy while managing risk. It's not about anything else other than that. And so that's really what you should be able to expect. And, one of the things that we realize when we start talking about risk is that many people are, when it comes to uncertainty, we start having a feeling of doubt and fear. And really understanding what risk we're being exposed to is very important. So on this following slide, when we take a look at the slide, and many of you have probably seen this before, when we look at this slide and we look at these three guys, it looks like they're having a nice time and they're not in a very risky situation. But when we actually show you where they are, we recognize that and that's on the next slide, they are actually in a precarious situation. And so, understanding the risk that you're in is very important.
That's a very famous photo, I think, from the 1930s or 1940s. And they were actually in New York working on a skyscraper. And it always stuns me when I look at them sitting there calmly eating their lunch.
Absolutely.
One gust of wind and they all would have been gone.
Right. Well,
by the way, I want to mention that one of our an important part of what we do for clients is protecting you from making bad decisions in scary markets. And that it can be so damaging. Just recently, we had a couple of clients that insisted that we sell them out of their portfolio, unfortunately, and they may have actually had to sell at the bottom of the market.
Well, there was actually only one client, specific client that did that, and they didn't understand. They actually asked me to predict what was going to happen over the next year, and their view of what's going to happen the next year was not very positive. But that's the perspective of everything. And that's why we really want to have this conversation, is the idea of we are managing every risk associated with the different securities that we have you invested in. And then we want to help you stick with the discipline and understand what's going on, because it's really, really important. And so the next slide is actually a really interesting slide, because this shows you how markets go up and down all the time. And what you're actually looking at is the bars are the specific returns from 1979 through last year.
The blue bars.
The blue bars. And the black lines and red lines are the whiskers, are the intra-year returns in each year. And so, for example, if you look at 2009, you can see that the return overall for the calendar year was 28%. But there was a decline of 27% in the beginning of the year up until April. And then following that, there was a positive return of 79%. And so some of the years it can be shocking, really a wild ride. But every year we see these fluctuations. And so,
well, even in 2020, which was the onset of COVID, the market was down 30%.
Yeah, you can see that big breadth of returns there.
Yeah. And 2021 kind of spoiled us because the intra-year decline was so tiny for that year. So I think many of us got spoiled, and I think it fooled some investors too into possibly going into the market and not really having experience of what really happens in the market. So, they were fooled.
Well, Steve, actually, when you look at the past decade, even, prior to, following 2008, 2009, it looks like it's been kind of slow and steady, not as choppy. The breadth isn't as wide. And yeah, people got a little bit complacent in thinking that the
Yeah.
market generally doesn't fluctuate this way. But the truth is that it does. And if we had a chart that showed even going back behind prior to 1979, you would see a lot of the fluctuations there as well.
And by the way, I want to mention one thing is that part of our job also is protecting you from some risks that you're not even aware of, and you have been protected against them, and are not even aware of what we're protecting you against. In part, for example, the terrible return on bond funds this year, for example, even many bond funds are down 10 or 12% for the year. That's because interest rates rose, and most of you have been protected against that because we hold individual bonds, which we're going to generally hold to maturity. And by the way, I did a calculation on one particular bond fund. I looked at its return for the year. It's like minus 10 or 12. And I looked at its current yield, which is about 3%. Maybe just do simple math. Looks like it's going to take you 4 years to recover that decline. That's a long time.
And that's just one, right? Yep. Another thing we're protecting from is being invested in stocks that had too high PE ratios, yes, was too speculative. There's a lot of things that we're protecting. But right now, specifically, we want to focus on Steve, can you go back? I think there's.
Oh, sure.
Oh, no, I'm sorry. Yeah, I guess you can go ahead. Okay. Steve's driving and I'm on the backseat driving. Just this kind of, we're trying to protect you from making these emotional decisions, acting from impulse. And there's always the feelings, we all are human, of the fear and greed, and we want to keep you away from making these sporadic decisions. And so the following slide, I think, is the real slide that I wanted to even go past that one. And that is this slide, because I love this slide. This is just so demonstrative of what possibly can happen. And this is what happened last decade, not last decade, but the prior decade, 2000 to 2010. Right. The market went pretty much up, down, sideways, and kind of landed pretty much where it started. And that's represented by the line on this graph. However, if people just sat in their seats and did not do anything, they would have been not too damaged. Unfortunately, what we saw was money coming into the equity market, represented by the bars on this chart.
That shows the flows into it, yeah.
Right, and money coming out of the market, which you can see especially occurred primarily in 2002 and in 2008, 2009. Yeah. And so, and take notice that that was when the market was down. And so imagine if you put $1 million in the beginning of 2000, and then in 2002 you took it out, and so now it's 500,000 because it literally halved, and then you put the $500,000 in again somewhere in the neighborhood of 2006, 2007, and then you took it out again in 2008, 2009, and it halved again. That is how somebody has $1 million portfolio turned into $250,000. And unfortunately, we see this more often than not.
And we've seen this permanently damage some people, and it really prevents them from ever investing again, because what they do is they conflagrate what happens with the market with their reaction to what happens. And it's a big difference. And many times it's their reaction to what happened to the market that's most damaging, not the market itself.
And you know, Steve, we can't completely blame the
consumer,
because many people don't have the education experience that we have over, years and years of watching how this works, how the
way our brains work. It's that the flight thing we have in our brains, that when we see some kind of risk or something scary, we immediately want to run away from it. We all have that.
Right. But you know who I blame even more so is I blame the media, because the media and the media, they act like they know what's going on. These are not people that were educated in finance. Nope. They have no experience in finance, and yet they write an article or they talk about it on TV like they know what's going on. And so there's a couple of articles that I actually pulled to show everybody what's going on. If you even could go past that, Steve.
Sure.
This is one article that came out in 1974. This was after
Newsweek, the great experts at investing.
yeah, this was actually after the Nifty 50. I don't know if yeah, we were kind of young then, Steve, but I remember conversations about the Nifty 50, the which were McDonald's and Avon and Polaroid and all those.
Well, they considered those you can't lose stocks. If you own those 50, you never lose.
But they had PE ratios of 50, Steve.
Yeah. Which is
and so, you know, at what point do you think that's a problem? Of course, they came crashing down, and they lost almost 90% of their value in 1973 and 1974.
Terrible bear market.
But yet, if you look at that line on the bottom where I pulled actually the return following 1974.
Yeah.
I think 1975 we had a return of around 32%. In the following year we had a return of 19%. And you know, the thing is that there was the Vietnam War, there was the oil embargo, there was 9% unemployment, there was
stagflation,
Watergate, which is so the political. There were a lot of things going on. The Franklin National failure. There were things going on that made people feel like, oh, the media must be right. We must be heading towards a doomsday scenario, and so people capitulated, and unfortunately, they lost their shirt. They locked in their losses, and never recovered from that.
And I want to mention, you really lose on these high price to earnings ratio stocks typically. And we're seeing that again this year. Some of these high price to earning ratio stocks are dropping the most. And you know, when people say the market's overvalued, you always got to look at how the market is divvied up and how much of it's concentrated into these high price to earnings ratio stocks. And a lot of times if you extract them from the average, it's not quite as overvalued as one would think.
Right.
But you really, the media though likes to tell you that though. But
well, because they have no idea what they're talking about.
No, they don't.
The next slide is
I think basic math fails most journalists. But
this one in 1979, August of 1979, this came out in Newsweek, basically saying that you better pull out all your money because equities are dead, and this is, you know, a real problem. And again, people capitulated. And if you could show the next slide, Steve, it shows exactly the period of time that this article came out.
That was a great signal to invest.
Absolutely. When the journalists who have no idea, or your cab driver has no idea, or somebody starts telling you to pull out of the market, that is when you should start investing for sure.
Yes. Yep, exactly.
And there's a bunch of just to really quickly go through them. We don't have to talk about all of them, but in 1987, you know,
and it took about 18 months, by the way, for that so-called crash, for the market to recover after that crash, by the way. That was at, I think it was October 29th, 1987 that happened, I believe.
Yes. Or 19, I thought it was.
Yeah, it might have been. Oh, yeah, you're right. Might have been. But it took like 18, 19 months and it fully recovered, you know, after that.
Right. Here's another one. And I love the wording here too. You know, I would say we're in a recession, but that's not a strong enough word. We're heading towards doomsday, everybody. And, you know, unfortunately, we were coming out of the recession at this point.
Well, let's face it, these magazines, they love these headlines because the goal is to sell the magazine, not to provide useful advice.
But we hear this on the news, Steve, also
all the time. Yep, all the time.
Another one, this was if you click again, I think it'll show this was 1992. Yes. Yeah, this was, by the way, Clinton used this because, you know, what did he say? It's the economy, stupid. And so he won an election out of this, but we were actually.
And that was sad because the economy was recovering, but the media apparently refused to acknowledge that, I guess.
Right. Well, again, they don't understand. This is, you know, again, you know, hyperbole in terms of getting people scared. There's another article, I think, on the next one, SARS, the Y2K, I mean, when you hear,
you know, I laughed at people with Y2K. I remember going to actually an AFA conference in 1998, and that half the conference was in Y2K. And myself being an engineer and also a major in computer science, I laughed at that and say, Y2K, what are they worried about? I remember them claiming you wouldn't be able to withdraw money from your bank account using your debit card.
Well, I was working as a CFO for a major corporation at the time, which I won't mention, and we had troops, like army troops, dealing with that situation. It was wild. You know, 2 years ago, 3 years ago, they were actually talking about the fact that inflation was dead. So, you know, again, you know, the whole just it's all about selling entertainment. It's not about really telling you the truth. And so,
That's right.
you know, the other thing is, you know, listening to friends and family and people who don't know what they're talking about the
Mhm.
next great tip or whatever is usually a bad thing. And then
Or your
Stevie,
cab driver.
right? And then if you want to go a little bit and even past this, the whole idea of predicting the future. This is actually a funny slide that I just wanted to kind of give everybody a picture about is how many times are you one of those people that likes to switch lanes all the time? And when you switch lanes, do you feel like you actually are in a better position, or have you just created a lot of stress and anxiety inside of you
Right.
because everybody's really going in the same direction? But there's a research group, Dalbar, who's done a lot of studies, and they do the study every year. And so we took off the years actually, because it's the same thing every period, where they look at the past 20 years and they look at the average return that the S&P 500 had,
Right.
which is demonstrated in the turquoise bar, and then the average return that the average investor received, which is in the yellow bar.
Much
And
less.
we can see that, you know, the average investor doesn't perform as well. Why? I mean, you can talk about all kinds of things like, oh, expenses and so forth, but that's not it. It's the problem is that people chase returns. They
Foolish timing
go,
decision.
yes, they go into the market at the wrong time and out of the market at the wrong time. They do
Well,
all
also, if it's a taxable account, they will also generate tax events, which were unnecessary.
oh, yes, and that's not even measurable in this.
Right.
Um, But on the next slide, there's a little picture of, well, actually, oh, this talks about also the worst, taking money out of the market. So over 1991 through 2021, $1,000 invested would have given you $27,000. But if you missed the worst week, 22,000, the worst, I'm sorry, the best week, the best
Yep.
month, 21,000, the best 3 months, you can see how it starts declining, and that you want to make sure that you are constantly in the game. You don't ever want to be on the sideline watching that, because you're going to miss
Yeah.
the big
I
opportunity.
don't believe anybody can time this. And we showed this in another video that when the market recovers, typically the recovery is fast and furious. The first 3 months, the market's up, in our experience, between 20 and 25%, just in the first 3 months of the recovery. And that's historical. We looked at this and we examined this, and that's what we've seen. So try to time that. You missed the first month, you might have missed, 10% of that recovery, which is huge. And you're never getting that money back ever, if you
Yeah,
miss it.
I think there might be another slide similar to what you're talking about. Well, it may be coming up afterwards, but this is actually just a really interesting thought about how people will guess something like even jelly beans. An advisor actually put a thing of jelly beans on their desk, and they had all their clients come in and tell them how many jelly beans were in the jar. They guesstimated. And so the range was between 409 and 5,300, but the average was 1,653, and the actual count was 1,670. And it goes to show you that individually we can make wild errors, but when we take into account all of our choices and all of our decisions, we start narrowing down and coming to the actual number. And so
Right.
if you go to the next slide, Steve, it actually shows what's going on in the market. We have all these buyers and all these sellers, and they're all bidding and asking for different prices of a particular stock. And so the equilibrium in the market is exactly that. It is the best guess of all the information that all the people that are participating in the market know. And so why would we try to second guess that? I always try to show
And
this slide to my husband, because he'll come in and say, oh, I think this is the next best choice. And I let him, I let him play with some money. He has this little play money. And every time he does this, and I hope he doesn't watch this, but every time he does it, his choices are always a disaster.
And by the
Because,
way, this is an important slide for another reason too, because an important theory came out of this. And I'm not going to get into the technicalities of it. It's in another one of our videos on YouTube channel, because we actually taught this concept at the NAFA conference a year ago. And that's something called the Black Littman model. And what you're actually doing is you extract the views on future returns for the market from this, what you said, this equilibrium figure, which, like you say, is I would say the best knowledge of all the traders combined.
Again, another slide just to demonstrate that, when we step back and we look at the returns over longer periods of time, that the markets reward discipline. And even in the 2008 disaster, it was appropriate to just stick with it and just let it ride out. And if you did that, you would be fine.
Well, I want to mention a couple times in these market declines, I've had people come up to me and say, do you think the market's going to go down to zero? I said, my usual response is, well, if you expect us to be living in caves again, and all these assets that are built up in the economy to be worthless, I don't see that happening ever. And, it's going to keep going up in the long run as the economy grows.
Yeah, I mean, that basically means that we have no more population growth, and that people don't need any of the products or services that are required to live.
That's right. And 60% of the economy is the consumer and the purchases they make.
Just another slide to show, after market declines, usually 1 year afterwards, and this is just an average from 1926 to 1921, after the market declined by 10% or more, that usually the rebound 1 year, 3 years, 5 years was a significant, nice return.
That's right. These are annualized returns, right?
Yes.
Yes. So 5 years, in other words, you earned roughly almost 10% a year for 5 years in a row.
Yeah.
Almost. Yep.
And these are just a couple of more recent events that many of the people on this call may recall, and the returns 1 year, 3 year, and 5 years after. So as we were talking about the October 19th, 1987 crash, what happened the following year? 19% return, 3 years after 32%, 5 years after 61%. So again, stay in your seat once you're actually in the market. And if you don't think you can ride the roller coaster, even a smaller roller coaster that will tend to put you in. I mean, we can put you on a smaller roller coaster, but you need to stay in your seat so that you can achieve the returns over the long run that we're trying to get you to.
Yeah, you need
experience.
to capture the recovery. You need to capture the recovery at this point. And the way we structure our portfolios, you need money from your portfolio. We have bonds, safe bonds in there that can be liquidated. They're generating income, and hopefully that should be more than enough to get you through any bear market. And the average bear market's 18 to 24 months on average. So, I mean, we haven't seen them last that long, but of late, but I would expect them to start to be more in that realm again, 18 to 24 months. I like to use that number.
So, the whole idea here, John Templeton was quoted as having said, if you want to make a better performance than the crowd, you must do things differently than the crowd, which means you don't follow the herd. And when the herd is all saying, run for the exit, you don't run for the exit. As a matter of fact, when the market is really down, people talk about the fact that that's a great buying opportunity. But you need to understand what the risks are that you are invested in. You want to understand what the exposure is around your
Mhm.
interest rate risk, around your credit risk, around your market risk, around your liquidity risk, around currency risk, political risk. And so we've done all that analysis, and we tried to share that with you in your initial strategy and
Yep.
ongoing. But it's important that you understand what risk really are you exposed to, so that
Right.
you can remain seated.
We have a good feel for each one of our models regarding what risk is inherent within that model. In other words, how much it can decline on average and that type of thing. Look, it's no guarantee of what's going to happen in the future, but we do have a reasonable sense. I will say that.
And the models that, I mean, we are always keeping in mind even some of the worst case scenarios that we've had throughout the
Mhm.
history of investing. Um, Things are often different. That different things pop up. But even when I was talking about the 1974 scenario, that scenario felt an awful lot like our current scenario is feeling, with
Yes.
political things happening and war and all those other things
High
going
inflation
on.
and
Yeah.
yeah, high energy prices and yep, and uncertainty even with respect to the war in Ukraine regarding whether what will it expand to involve more of Europe, of course.
So it's important that you understand your overall risk, risking your risk against a disaster, and just the whole management of risk. And on the next slide, we just mentioned, once again, that you want to make sure that you're discussing risk management with our firm,
Yes.
and you understand the components of risk that you're being exposed to, and that you understand how we're defending you against those risks, because that should hopefully make you feel more comfortable. Quarterly meetings, we really want to encourage you, if we haven't spoken to us in a while, that you do
Yep.
contact us. Ongoing Monte Carlo probability analysis, where we can show you best case, worst case scenarios,
Yes.
really, really important. Updating your financial plan and making sure that you can still achieve the goals that you've set forth. Those are really important things for us to do. So
Yep.
please, again, as always, we welcome your phone calls. We want to talk to you about what's going on. So thank you for listening to us, and we hope to hear from you soon.